Last week, we talked about a ratio that I consider to be one of the most important indicators for profitability in a business, and that was the labor efficiency ratio. So if you haven't watched that video, make sure you go back and watch that one. But this week, I want to talk about another hard and fast rule that I think is really important, and that is, what should your profit percentage be in your small business? There are lots of different people who have different rules out there and different targets, but I will tell you from what I've seen working with small businesses, and specifically with service-based small businesses, because that's mostly who we work with here at Clara CFO and who we've been helping over the years. We've helped all sorts of different types of businesses, but specifically service-based businesses. I want to give you some rules around profit. So if that sounds good, please stay tuned. If you aren't already subscribed to the channel, please go ahead and subscribe. You know, if everybody was subscribed who watched these videos, I wouldn't have to say this during my videos. So go ahead and subscribe and it'll help me get to the point a lot faster. Okay, thank you. Profit percentage. So depending on the different businesses and different industries, there will be different profit percentages. So there is sort of that overarching, well, it depends, answer that does happen. But I kind of want to scrap the it depends, and I want to give you guys a target and something that you should be shooting for. So as a small business owner, you should be making at a minimum 15% profit in your business. And when I say percent profit, I'm literally saying go to the very bottom of your profit and loss where it says, if you're in an accounting system and it says net income, take that number and divide it by your top line number, your total revenue. So profit divided by revenue equals your profit percentage. This is before any taxes are taken out, okay? So at a minimum, your business should be at 15% profit margin. Now, why do we say 15%? Because really, there are lots of businesses, and especially big businesses, and when you get into public companies, a lot of them are at a loss. They don't have a profit percentage, they have a loss percentage that they're keeping track of. But the truth is that those are businesses that are operating on cash that is coming in from investors. And small businesses cannot operate without cash for very long. They have to be profitable. And we can borrow money, we can have cash coming in from that, but the only way to pay off borrowed money is to start producing positive cash flow, which comes from creating a profit. So you are at risk of the IRS considering your business a hobby if it does not produce a profit in 3 out of 5 years. Okay, so if your business is continually producing a loss year over year over year, you do run the risk of the IRS saying, hey, you need to move along here and do something different, because they're just thinking that you're finding ways to spend money that you can write off as a tax deduction, and we won't get into all of that. But the point is that businesses ideally should be producing positive cash flow and they should be producing a profit. So 15% is the minimum. Now, I would also say that is backed up by my friend Greg Crabtree. I'm going to sound like I'm a prophet for, okay, whatever. So yes, a prophet of profit, but I am also a evangelist. I will use the word evangelist for Greg Crabtree's books, but I am because I agree with him. When Greg talks, I'm like, yes, that's exactly what I see in practice. And what I see is that oftentimes businesses that are operating at 5% or margin or less are really, really struggling. And he talks about in this book that 10% profit is the new break even, because really that's really not a ton of cash to really be doing much with. You're not really in any place where you're producing enough cash to really be moving the needle forward. So you really need to be at 15% or more in order to be in that really good, healthy place as a business owner. Now, I would say, and I would argue, and I'd be happy to have this conversation with Greg directly, that most of our service-based businesses, especially if they are operating virtually and don't have very high overhead for actual physical locations, that most of us can be at a 20% profit margin with a little bit of work. We can get to 20%. So we actually use the target of 20% profit margin for our B2B service companies that we work with when we're talking to them and we're making decisions and we're planning budgets. And when we are making financial decisions, we're really targeting that 20% profit margin. Now, what we find is when we do implement implement the labor efficiency ratio, if we really can get to that target of 2 or more, which is the last video, again, go and watch that video if you haven't already. If you can get to that, the 20% margin is very realistic. Actually, in that video, I used an example of a consulting company that was at a 21% profit margin, and they had an LER of 1.94. So sometimes you don't even have to get to 2 in your labor efficiency ratio in order to reach that 20% profit margin. Okay, so these are 2 numbers that we use, the LER and then the profit margin. And I'm just saying that LER is calculated higher up on the P&L than the profit margin. That's why my hands are going all over the place. But those 2 numbers can really help us measure profitability for the business and help us identify where the problems are. So let's say if you had an LER of 2 and you took into account all the nuances that I talk about in that video and you had all the appropriate costs incorporated, but then your profit margin was 10%, we would need to look at operating expenses. That's where we would say, something is off here. Maybe you're spending way too much on marketing. Maybe your travel and food budget is just out of control because the owner is putting every single thing they do with their family into the business. You know, there might be lots of other things that are siphoning off cash in the business that are affecting your profit margin. So these 2 things used in conjunction can really help tell us a lot about the P&L. Okay, so definitely want you to be closer to 20% if you are a service-based company. Now, there are going to be industries that operate at lower margins. However, you need to think about, as a small business owner, what can you tolerate? What can you tolerate as a business owner? Can you tolerate a 3% margin year over year over year over year if you're only making $200,000 to $300,000 in your business? No, you probably can't. Like, you can't really, it doesn't make sense for you to be doing all the work of owning a business if you're just making a teeny tiny little bit of cash flow. You know, so you need to think about these things because they do matter and you do need to make sense. They need to make sense for your life. So pay attention to your profit margin is what I'm saying. If your profit margin is too low, a couple things you can think about. Raising prices, looking at all your expenses and cutting expenses. That can be your direct costs, directly, cost of goods sold. That can be your labor costs. That can be your operating expenses. You need to look at every single line in your P&L and look at cutting costs in every single spot. A couple other things you can do is you can increase volume. So when it comes to increasing revenue, which is your top line number, you can increase prices or you can increase volume. Those 2 things. Now, with increased volume can also come increased costs. So you need to understand how your business model works to understand if that's actually going to make a difference. I've worked with companies that they think that just like adding more and selling more will do the trick to get them out of their profit problems, but it doesn't actually always work that way. So you need to understand your business model to understand if that's actually going to improve your business by doing that and if it will actually improve your percentage profit at the end of the day. Okay, tell me what you think. I'm open to your thoughts. Tell me if you have done these 2 calculations, labor efficiency ratio and profit, and put them in the comment section below if you're comfortable. I would love to see some people's real numbers after you've done this. And, if you don't even feel comfortable doing that, email me. The email is hello@claracfo.com. Email us your labor efficiency ratio and your profit percentage. And if you're not understanding why your labor efficiency ratio might be good but your profit percentage is not, make sure you watch the labor efficiency video and then think about all the things that I mentioned there. And then I'm happy to answer some questions there. If we want to try to go through a few scenarios, that might be a great idea for a video. So feel free to email me. I'd love to hear from you guys. So okay, that is my opinion on profit percentages, and I'd love to hear your thoughts as well. Thank you so much for being here, and if you found this video helpful, please go ahead and give it a thumbs up. I would very much appreciate it. All right, bye everybody.